This second chapter, chapter 12 in module 7, we are going to really expand on the statement of cash flows. Now, back in module 1, I had mentioned that I didn't really like doing the statement of cash flows way at the very beginning of the semester because so much goes into it and there's so much you've got to understand about accounting that it doesn't make a lot of sense to do it. And so kind of with that in mind, there's a whole chapter just on the statement of cash flows at the end of the book, chapter 12, that really goes into the statement of cash flows a lot deeper. I like to start off with, well, why do we even do the statement of cash flows? And you could think, well, the statement of cash flows, I understand it tells me where the cash is going, but can't I just look at the income statement and be able to tell that? And the answer is, well, the income statement gives you a good starting point, but it doesn't tell you everything by any means. And you also have to remember that in accounting, we do it based on the accrual method. And the accrual method says you record your revenue and expenses when they happen, not necessarily when cash is paid. So cash could be paid ahead of time, like for prepaid expenses, and it's not going to show up on the income statement. Or cash could be deferred for later. Say, like if you're buying advertising and you're going to put it on account, then it's going to show up like you spent money because you had advertising expense, but you really didn't. You're going to pay it off in a couple months next year. So that's what I put up here just to kind of give us a brief little visualization, is what if the company had revenues of 10,000 and then you add up all of their expenses for the year and it's 9,000, and you'd say, oh, well, they have net income of 1,000. So therefore, if they brought in $10,000 and paid out $9,000, they should have $1,000 cash. But if we looked at the balance sheet, it says, no, they have $5,000 cash. Well, why is there a difference? And that's what the statement of cash flows is going to tell us, and it's going to show us where all of our cash is spent. We can see where cash could possibly be spent and where it's probably coming in the most. But there are some things on here on the income statement where cash is never spent, and the depreciation is one of them. You never have a depreciation expense and then a credit to cash when you're doing your annual depreciating of the equipment. You always credit your accumulated depreciation. So that's one of the things where, and this number 2, where I start listing some items where it's not really clear where by looking just at the income statement. And one of them is the depreciation expense. Yeah, it looks like it affects cash because it brings your net income down, but it doesn't. Another one could be wages, the wages expense. I don't have this one just necessarily listed on here, but a wage expense, you could have a credit to wages payable for at least some of it, maybe not all of it, but maybe 1,000 of it you are going to pay into the next year because it's the end of December. So I put some other things on here that some of them don't even affect the income statement at all. Like, what if you bought equipment with cash? Well, the equipment goes on the balance sheet. It's not on here anywhere. And the cash is on the balance sheet. So neither of those show up as an payment going out. So we wouldn't know that we spent $4,000 in cash unless we look back at other journal entries. But from a statement perspective, the income statement's not going to tell us that. Same kind of thing here, 2 balance sheet items. What if I sold stock and got money? Just like what we did last week or on just this last chapter. If I sold stock, that's owner's equity. It's on the balance sheet, and the cash is on the balance sheet. It doesn't show up that I got money. It's one way I got money besides just the regular revenue. The AR is going to come into play. Accounts receivable. If accounts receivable started going up, that means I didn't collect the money. I'm going to collect it later. Well, that's possibly going to affect this, or it will affect it. That means if my AR went up, I didn't get 10,000 in cash. That means maybe I got 8,000. If my AR went up to 2,000 from last year, that means 2,000 more went into account and I just haven't gotten that money yet. So I didn't get the full 10 grand. And then I put one about the prepaid. We kind of looked about that. Purchased land on a note. Well, this one that you're going to see, this one doesn't affect the statement of cash flows at all because there's no cash being spent or received. They're both on the balance sheet. Neither of them affect the income statement. And that's going to lead us to one of my next questions here. How do I know if something even goes on the statement of cash flows? Ask yourself these two questions. Did the transaction involve net income? And then ask yourself, does the transaction involve cash? So you've got to actually physically write out the journal entry when you're given things like this. If you can't really visualize it in your head what the journal entry looks like, actually write it out. It's not a big deal. And then C, does the transaction involve net income? And what I mean by that is, does it have a revenue or an expense attached to it? Is one of the debits or credits a revenue or an expense? Because if it is, then it's going to affect net income. Then once you've asked these two questions and you have yes or no's, then you've got to have a little answer key that tells you what to do with that. So if only one of the two questions, doesn't matter which one, but if only one of them had yes as the answer, then the item goes on the statement of cash flows. If both of them had yes or neither of them had yes, then it does not go on the statement of cash flows. And I'll try to explain more of that, how these two work, as we get into some practice example here in a little bit. But we'll keep these in mind. That's why I have them highlighted in yellow. That this is how we're going to know if something goes to the statement of cash flows, by answering yes or no and then looking at our little answer key. Okay, so now we kind of get into starting to prepare the statement of cash flows. There are three things you really need. You need a comparative balance sheet, meaning you have the end of last year's numbers and you have the end of this year's numbers. So you have to have that because you got to know how your balance sheet accounts, if they're going up or down. You got to know the difference. And then you have to have this year's income statement, because you got to know what your revenues and expenses are and your net income. And then finally, any long-term assets or any long-term liabilities or any owner's equity items, you need to have some notes on them. Because if equipment goes up or down, you need to know why it went up or down. Did you buy something or sell something or both? So you have to be provided with that. Otherwise, you will not be able to do the statement of cash flows correctly without having those additional notes on why those long-term items went up or down, or the owner's equity. Okay, there are two methods to doing the statement of cash flows, the indirect and the direct. We're going to focus on the indirect method the most, and then we're going to finish up with the direct method, and you're going to see that the difference only lies in one section out of three. The other two sections are pretty well identical. So when we start off with the indirect method, it has three parts. Just like the balance sheet has three parts, has assets, liabilities, and owner's equity. This one has three parts as well. They're just called something different. They're called the operating, the investing, and the financing. With the indirect method, the one we're going to start with, this is something that you're, as you're going through and doing the problems in Connect, I would have, or just print out and copy and paste this maybe all to one page. It's pretty much all in one page now, but you could just get rid of this and have it all in one page. This is really going to help you, something I've made up. This is really going to help you, I think, with doing the statement of cash flows. Because when you, it's always going to be the same. When you're doing the operating section, you always start with your net income, because that's a good place to start. It gives you a good idea of where cash is going. It doesn't tell you everything like we just talked about. But then we start changing some things to make it where it does tell you everything where cash went. So basically what you're doing is you're taking the income statement from the accrual method and we're transitioning it to the income statement as only the cash method, meaning you only record things when cash happens, not necessarily when the event happens. Like let's say you sold some merchandise on credit Well, in accounting with the accrual, we record that as revenue, but for the cash purposes, we would not because we didn't get money yet. Okay, so when we start out with net income, the first thing there's two things we're always going to look for on the income statement, just two. And then the rest of them, we're going to go to the balance sheet, the comparative balance sheet. First thing, these two things never involve cash. Their journal entries do not involve cash, or at least they're part of it. The depreciation. Depreciation never has cash paid out. So what we're going to pretend is to pretend like the depreciation never happened. Pretend like we never made that journal entry. So we're going to, if we pretend it's not there, that's going to make your net income go up. So if, let's say we started with 10,000 and we had 6,000 of depreciation, if we pretend that that expense never happened, well, that's going to make my net income go up by that 6,000. So whatever depreciation is, we're going to add that back as cash being added back into the net income. Then we're always going to look for a gain or a loss, because gain or losses, they just tell you how, in comparative to the book value, how close were you to your selling price, in your selling price. If you have a gain, that means you sold it for above your book value. Doesn't mean you got extra money, just means you sold it for above the book value. So if you have a gain, then it's going to show that your income went up, but we want to pretend that that gain wasn't there. So we're going to take the income back down by the gain amount. Or if there's a loss makes your net income go down. If we pretend it's not there, then we just take that loss back out and our net income goes back up. So that's why I have these here as, if it's a gain, we're going to take our cash value back down, put it in parentheses, whatever that gain is. And if it's a loss, we're going to add it back in, just like what we did with depreciation. And then we're going to look at we're going to go to our balance sheet and we're going to look at all the current assets, excluding cash, because this is the statement of cash flows. And we're going to do cash at the very end. We're going to look at all the other current assets. So accounts receivable, we're going to look at prepaids, we're going to look at inventory. Those are the three big ones that we're going to be looking at for current assets. If the current asset, so like AR, think of accounts receivable. If your current asset increased, so your AR went from 4,000 to 6,000, that means you collected less money. More people owe you money. So if your AR goes up or any current asset goes up, that difference, we bring our cash down. And then just the opposite is if the current asset decreases. So let's say our accounts receivable went from 10,000 down to 7,000. If it goes from 10 down to 7, that means I collected money, most likely, unless I'm told otherwise that, oh, well, the reason it went down is because one of the person's account went default, and we're never going to collect it. We'd have to be told that. But if we're not told anything like that, and we won't have anything like that in these problems, we assume that we collected the money. If it went from 10, somebody owing me now only 7, I collected money. And then we're going to go to our current liabilities. So we're going to skip the long-term assets. That's going to go in a different section. And we're going to go into our current liabilities. And it's going to be just the opposite. Because if our current liabilities go up, so think of like accounts payable. If I owe somebody 2,000, but now I owe them 5, that means I didn't pay the money. I expensed something perhaps, but I didn't pay it off. So it looks like I spent the money, but I really didn't. So I'm going to add that cash back because I temporarily saved the money. And then just the opposite, if my liability goes down, let's say my wage is payable, it went from 3,000 down to 1,000, that means I paid my workers. And if I paid them, I need to show that I lost money. Then what we're going to do is total up this first section. And we're going to take our net income and then plus or minus all of these that we have. And we're going to get one final number. And most likely, in almost most circumstances in our operating section, this is going to be a positive number. And it's going to say total cash provided from operating section. And I put provided in there in a special emphasis because the book is going to look at that in particular. You put provided if it's a positive number, and you put used if it's a negative number. So it'll say total cash used by the operating section. That's when it's a negative, and make sure you pay close attention to that. The investing section, it's going to look very similar, just like your current assets up here. The current assets are going to be almost identical to the investing, whereas if your amount went up, like if you purchased equipment and then you paid cash for it, well, obviously your cash is going to go down. If you sold equipment and you got cash for it, your cash is going to go up. So it's pretty self-explanatory here. We always look at all of our long-term assets, except we do not put on there accumulated depreciation, because accumulated depreciation, we already affected that up here. We don't want to put it in twice. We put it in when we did the depreciation expense for the year. And then finally, our financing activities. Financing are going to look just like our current liabilities. So therefore, if our long-term liabilities went up, we technically saved a little bit of money for the current purpose in cash. If our long-term liabilities went down, we probably paid them off. And then if we have a dividend, then obviously we paid out dividends, so we've got to show that as well. And all of these, we're going to say either net cash provided from investing or net cash used if it was a negative. And then the same for financing, net cash provided by financing or used. And then at the very end, what you total up is you go back up to that number you didn't use. You go back up to cash, because we did all the current assets except cash. And we put down our cash at the beginning of the year, the end of last year. And then we add all three sections, financing and investing and operating, and we put them here. So, and then we add the two, beginning plus our changes, our total net change. And that number better be the end of this year's cash. And if it is, then we did everything correct. All right, we'll get to the direct method in a second, but I think what we're going to do now is we're going to just jump in and see how a real statement of cash flows looks. So with that, I'm going to now open up another screen share. We're going to do the full screen. And we're going to look at the two examples that I have up. So if you go ahead and pull up your examples, this number 52, we're going to look at the 2017 tab. And then I've got an answer tab out here to the side as we go through, so you can see what the statement of cash flows look like. All right, so this is what you would be given. A comparative balance sheet. Remember, you need 2 years. And then out to the side, I went ahead and put the change for the year. You wouldn't necessarily be given this. Sometimes you are, sometimes you're not. So I went ahead and did that just so we didn't have to calculate it, everything. So for example, like AR, and notice, I need to really make this point right now, is the book does it opposite of me. It's just in my personal nature to read things from left to right like we read everything else. A lot of times in finances, they go backwards. They start with the most current year and then work backwards. So you're going to see that, and it just messes me up. But I went ahead and left it like this just because it's the most familiar for me. So I read it with the last year being the most recent. So remember that the book is going to have the left over here being the most recent. So they're going to have 2017, 2016, or whatever years they use. So here, the AR went from 47 last year down to 36 this year. So there was a net change of $11,000. And I did that for all of the balance sheet items. And then down below, we have our income statement. And then finally, we have our notes. And these are the primary notes. We'll get down here to the direct method notes in a little bit. But these are the primary notes we're going to use to do the indirect method for the investing and the finance. All right, so let's just get into it. Remember, as we said in our little write-up here, that the first thing you always start with is net income. So I would have on when you're making this financial statement, start off with your net income. And we have our operating section, section number 1 out of 3. Net income, 80,000. Then we said, okay, we need to look for 2 items on the income statement, depreciation, and is there a gain or loss? So let's go ahead and look for those. Go down to the income statement. And depreciation would be in the expenses, and sure enough, we have one. 17,000. And remember, if I want to get rid of that 17,000, I need to act like it's not there. So if it wasn't there, my net income would be 17,000 higher because those expenses bring the net income down. So what I'm going to do is simply add back in the depreciation expense. I'm going to make it a positive. And that's what my notes tell you to do here. Whatever the depreciation is, add it back in. Now I'm going to look for any gain or loss. And what we have is a loss. And we're going to be able to explain that in a little bit. But for right now, it's just enough to know that we have a loss. And on my little notes, it says, okay, if there's a loss, that's the second item, we need to add it back to cash. And hopefully that makes sense because a loss makes our net income go down. Well, we want to pretend that didn't even happen because losses don't affect cash. So I'm going to put my loss on here as a positive to cash. Now we're going to look at, once we've done that, once we have looked at these 2 items, we're going to come down to the other part, and we're going to look at our balance sheet, all the current assets and all the current liabilities. Okay, so let's go back up to our balance sheet. And remember, we leave everything out except cash. Cash is going to be here, but I'm going to put it maybe in yellow, and we're going to know to come back to that at the very, very end because this whole statement focuses on cash. And then as I go through and I do something and I've touched on each one of these, I'm going to make it red because everything needs to be touched, but only once. So AR went down by 11,000. And in my little notes, it says, okay, if your current asset went down, which is the second one, you need to add that difference back to cash. And let's see why, so we don't have to always memorize the chart. If our AR went down, that usually means that people paid off their bill. So I got money. So when the AR goes down, our cash went up most of the time, unless you're told differently, like they didn't, their account went into default. It's going to be the same then for every current asset. So, okay, let's look at prepaid. Our prepaids went up, just the opposite. Well, if prepaids went up, that means I had to prepay, I had to pay for something in advance. It's not showing up as an expense because it's not an expense yet. So I need to show that I spent money. So when my prepaids go up, I paid 2,000. So my cash went down and it's not showing up on the income statement. Then our last one, inventory. Inventory is it's just like any other current asset. When inventory goes down, well, that means I expensed out some of that inventory as cost of goods sold, but I never replaced it. My inventory went down, and so I didn't spend the extra money to replace it. So my cash actually went up in comparison because the income statement with cost of goods sold is kind of assuming that I replaced it, and I had some extra laying around, and I didn't pay for that extra 10,000 this month. I paid for it a long time ago, and it doesn't matter what I paid for a long time ago. It matters what happens right now. And right now, I didn't spend that money, so I'm going to add it back into cash. It's easiest just to remember that if your current assets go down, your cash goes up. That's the easiest way to kind of think about it when you get started. And if your current assets go up, that means you spent money and bought some stuff or your clients didn't pay you, and then your cash goes down. So then we go to my little cheat sheet, and it says once we've done all the current assets, we go to the current liabilities. So let's go down here. I'm going to, all of these are now going to be red. I have done them. And to help remind me that I've done them, I'm going to mark them out. I'm going to go down to my current liabilities. So that would be the account payable and the wages payable. So let's do the account payable. My account payable went from 33 down to 23. And hopefully the only reason that it went down is because I paid off my bill. And if I paid off my bill, that means my cash went down. So, and this solidifies that here. If your current liability goes down, that means you lost money because you paid it off. You paid off your bill. So I come down here, I have a decrease in accounts payable. My account payable went down. That means I paid out money. So I need to show that I paid out money. I lost cash. And then my last one here, my wages payable, it went up by 1,000. So in the short term, I saved some cash. So my expenses would have showed extra cash being spent, but it really wasn't. So whenever current liabilities go up, that means my cash goes up. Now, as that is all that we had for current liabilities, I am now done with the operating section. So over here, I want to take my 80,000 and then combine it with everything that I have here. And what I went ahead and did is just put I added all of this up, and it comes out to be 28,000. So 80 plus the 28 here, I had net cash provided from, I'll put that word in here, operating activities, 108,000. Operating activities are your day-to-day things. These are things that change day to day. Net income, everything on the income statement, day to day, and then your current assets and current liabilities are all day to day things that go up and down. So I actually brought in $108,000 this year in cash. So I have an extra $108,000 to do stuff with. For the other two, investing, I can buy some equipment perhaps, or the financing, I could pay off some debt, but I have some money to work with. All right, so we're ready now for number 2, investing. Now, when we get to the investing, we're always going to have to look at our notes because to explain. The operating, you don't really need to look at your notes. Those are the day-to-day. We can just look at the number change. With the investing, I have to be more particular. I have to look at my notes. I have to see if my land changed, why did it change? Did I sell land and get something else? Or did I sell land and get money? Or did I buy land? And how did I buy it? Did I buy it on account? Or did I pay it with cash? We have to know, we have to look at our notes. All right, so land. Land went down for the year. So that means I got rid of some land. All right, why? What happened? So I come down here to my notes, and it tells me here that land was sold at book value for cash. Okay, I'm going to mark that one out because I'm going to be using it. Book value means I didn't have a gain or a loss. So whatever the difference is, that's how much cash I brought in. Because I could have sold the land for a gain. Just because I got rid of 15,000 in land, what if I sold it for 20? We wouldn't know that just by looking at this. But it tells me I sold it for book value, so I sold it for what it's worth on my books, 15,000. If I sold the land, that means I got money. So I'm going to come down here and show that. I'm going to show I had a sale of land and my cash went up by 15,000. And that explained all of that 15,000, so I can get rid of it. Now with the buildings, nothing happened with the buildings. So I don't have to do anything with that. I can just skip right on through that. And remember, we don't do anything with accumulated depreciation except help prove some numbers. Now, when you get to connect, and we're going to see this when we get there, they're not going to be necessarily as nice as I am, and I give you the amounts that it was sold for. They're going to actually make you figure it up. And so you will kind of use accumulated depreciation just to help figure some numbers, but never will it go over here into your actual statement of cash flows. You'll see what I'm talking about a little bit. All right, so the equipment had several things happening to it, or at least more than one. So when we go up here and look at this change, we're going to be notating this change in a couple. It's not going to be just 22,000 in a one-time transaction. The total is going to be 22,000, whatever it is. So we're going to have to prove this $22,000 change with these transactions. So let's see if it works. Okay. If I sold equipment for $20,000 cash, and it had a cost of $25,000, a book value of $21,000. Okay, so we got some different stuff going on here, and we got to think of how do I know how much cash was actually involved here? And we need to be able to provide the journal entry. The journal entry is going to be important. Let me see if I have these. No, okay. So we're going to put these right here on this page so I can begin to see what's really happening here, and then I'm going to get rid of them. I'm going to keep putting the same journal entries here. So if I was doing this journal entry and I sold equipment for cash of $20,000, that's going to be the important thing. And then I had this. It said it had a cost of $25,000 and a book value of 21. So if it cost me 25 and it's still worth 21, that should tell me how much accumulated depreciation that I'm getting rid of that had accumulated. That would be 4,000. Because if it's still worth 21 and I bought it for 25, I've only accumulated 4,000 in cash or in accumulated depreciation. Now, since I don't know what the gain or loss is yet, I'm going to come down here and credit my equipment. I'm going to credit the equipment for what I bought it for, what it's on my books. So right now I have almost the entire journal entry done, except my debits don't quite equal my credits. And that's because it was worth 21, but I only brought in 20. And I had a loss, therefore, a loss on disposal, $1,000. And looky here, that's where this guy comes into play. So I have just solved where that one came from, where the loss came from. It came from this journal entry right here. Now, I can come up here at 25,000 and equipment. I come up here. And part of that 22, part of it was a negative 25. So you think, hey, wait a minute, we went up 22 and this is showing down 25. Well, we're starting to explain it, but we're going in the wrong direction right now. But hopefully this number out here, this next number will help balance it out. So I'm supposed to explain positive 22. And so far, I'm not there yet. I'm actually went the other way. I'm explaining negative 25. All right, so, and then the last thing I'm going to look at is this number. This is what goes on my statement of cash flows, 20 grand. I brought in 20,000 on the sale of the equipment, not 25, even though that's what it was worth. I didn't bring in that. I put down what I brought in, the 20,000. Then I come over here and I see, okay, I've got one more item that affected cash. It says I bought equipment for 47,000. So I would debit my equipment for 47,000. And it says I bought it with cash for 47,000. So this equipment, this made my equipment go up 47,000. So over here, I'm gonna put in an equation now. Negative 25 plus 47. If I add those two together, I have now at 22,000. I have explained why the equipment changed by 22,000, because I sold some and then I bought more, and that's why the difference here is a net 22,000. So I have now explained my equipment, and then therefore we always get rid of the accumulated depreciation as well. So I'm going to come over here to my statement of cash flows because I just entered in this number. Now I just got to do the cash part. The cash is the same in this case. It wouldn't always have to be. Maybe I paid some down and some on a note. And if that case, it's whatever the cash is. What did I pay on it right now? And on this one, I just paid it all. So that's all I had on the investing. So the investing, I can go ahead and total up the difference. And this one actually is a negative. So I spent some of the money I had raised up here. And so we call this net cash used by investing. And then I'm going to get rid of these. These are now done. So I just have 3 things left that I need to look at. You would want to keep these, but I'm going to, yeah, we can keep them going down here. We have room. So our last pieces is looking at our long-term liabilities and our long-term owner's equity. Okay, so it says notes payable. Notes payable went down by $4,000. I look at my note, my little notes down here, and it says, yep, the reason it went down is because we paid on the note. So that's a pretty easy journal entry. Note payable went down $4,000 because I paid cash. So I've explained the note. The note is now done. And I show that over here in the financing activities. Payment on a note. I paid money, cash is going out. Bonds, same kind of thing happened with bonds. My bonds went down by $94,000, and it tells me that cash was paid to redeem the bonds. All right, so if cash was paid, I can get rid of my bond number. I can put the bond now into my statement of cash flows for that $94,000. The redemption or payment of bonds, either one would be fine, the wording there. Now, common stock, no change. So if nothing happened here, I can just cross this one out, nothing to put on the statement of cash flows. The last thing is the retained earnings, and it went up 62,000, but let's figure out why it went up 62,000. If you think of closing entries, and as long as nothing else happened to retained earnings, like sold treasury stock at a loss, but you would have to be told that. Let's assume nothing else happened. The 2 things that go into retained earnings when you close things out are your income summary, which is your net income, and dividends. So if I started at 30 and I added in my net income of 80,000, how much in dividends? So if I've just explained 80 of the 62, so I over explained it. How much in dividends then do I have to pay to get back down to 62,000 change instead of 80? And if you can do the math in your head, that means I paid 18,000 in dividends, which is exactly what my notes say. Now, in the book problems, they won't give you how much you paid in dividends necessarily. They're going to have you figure it by doing the method we just did. So this goes away. I can do a journal entry that shows I had dividends being debited, and I could just say retained earnings being debited by 18,000. And my cash was credited by 18,000. And then since cash was paid, I need to show that payment of dividends for 18,000. Now that's everything. I've done everything I needed to. I can put this one is now done. All of my items are red, except the very last item that I'm going to come to now. So we have our total financing. We're going to add them all up. So when we add all these up, it's a negative 116. So we can see that I actually have spent more than the 108 that I brought in. So my cash should have went down. And if I look over here, it did go down. Now we can just finalize it and say, okay, did I do it right? beginning cash was 90. When you add up the three yellows, the 108, and then minus the 12, minus the 116, you should get negative 20,000. And that just happens to be the exact same as this, which it always should be. And then when you add up these two together, 70 grand, that's what my cash is here. So I've explained why the cash went down $20,000. And that would be the indirect method. When we now get ready to look at the direct method, the investing and financing, we're not even going to do them because they're going to be the same. The only thing that's going to be different is our investing, our operating activities. So while we're still in the flow, let's just jump right into the direct method, and hopefully it won't take us too long because it's only one section. I'm going to pull back up my notes to kind of give us just a baseline of what we're going to do with the direct method. You can see it's not very long. We're going to have the same sections, only the operating is different. Okay, so what we're going to do is instead of starting with net income, we're actually going to take each income statement item, each expense or revenue, and then explain that with the balance sheet. We're kind of just working backwards in a way. Instead of just starting with our net income and then going to the balance sheet and look at all the differences, we're going to look at each individual income statement item and then compare that to its corresponding balance sheet item that would typically go with it. Like revenue goes with anything in AR. Cost of goods sold would go with anything in inventory. Any changes in inventory are going to be affected by that, with that. So when we have receipts from customers, we're gonna look at sales and put that with AR. And then we're gonna go to our cost of goods sold, and we're gonna combine that, and it's gonna tell us in the book, did I buy our inventory on account? Is that what mainly our accounts payable is about, buying inventory? And if so, we're gonna combine AP and inventory changes with our cost of goods sold. And it's gonna tell us then if we have any other expenses, what they go with, and with the book, it's gonna be prepaid and wages payable. We're not gonna, anytime we have any depreciation, that doesn't involve cash, so we just ignore that, or any gain or losses, we ignore it on the income statement because we're not dealing with net income. We're not dealing with the final number, so we don't have to adjust it out. Then we're gonna look at the income tax expense, and then how much did we pay compared with the income tax payable. And then when we're all done and we add up the direct method, it should be the same as the indirect method. So the indirect method here was 108. Hopefully we'll get that with the direct method. Okay, so let's try the direct method using the exact same items we were using, except we're going to be using some of this up here. So I'm going to undo the items we're going to look at, and then we'll cross them back out as we go through. So let's put no fill. All right. So these are part of the operating. These are the ones we're going to be going back and revisiting. Okay, so the first thing we do when we're doing the operating, but the direct method, we don't start with net income. We just go right into revenue. And we see that revenue is $400,000. But like my notes said, I have to then compare to, did I get more money or lose money in AR? So when I compare then this, and then I go back up, so my revenue of 400,000, and I go up to my AR says I actually collected more than 400,000 because my AR went down. I collected an extra 11,000 on top of the 400,000. So I can, let's knock this out. And I come over here, cash receipts from customers. This includes the 400,000 in sales plus the additional AR that came in. If the AR would have went the other way, if the AR would have been up in 2017 compared to 2016, then we would have subtracted the amount of difference. Okay, so we can mark out revenue. We're ready to look at cost of goods sold. 210. 210, we spent money for our merchandise. And then it tells us down here in our problem, this is where the direct notes come in. Inventory is the only account that uses the account payable. So we're going to look at cost of goods sold. We're going to look at inventory and accounts payable. So when I come down here to cash payments for inventory, I start with the 210 because I paid for that cost of goods sold. And then my inventory went, or let's start with AP. My AP went down by 10 grand. So that means I paid money. I paid off on some of my account payable from prior times. So I need to show that I paid money, an extra -10. But then to kind of counterbalance that in this one particular case, my inventory went down. So therefore I kind of saved money because I didn't replace some of the inventory. So think of cash as going back up by 10. So when those two cancel each other out, we're just left with the regular 210. It's usually not necessarily just going to be the same. These are not going to always cancel each other out. It just happened to in this problem. So I have now put these two numbers into my statement of cash flows. You can mark out my cost of goods sold. Wages expense. Well, we're going to compare that with our wages payable, obviously. Wages expense says 20,000. My wages payable says I didn't quite pay all 20,000. I put an extra 1,000 on account. So when I come down here, my payments for wages is going to be the 20, but that 1,000 that I have saved temporarily. So it's really that I only paid 19 as cash payment for wages. So I'm going to cancel out my wages and my wage expense. Interest. I come up to my balance sheet. I don't have any interest items that are payable. So whatever I have here as an expense, that's how much I actually paid. That one is really easy. Cash payment for interest, 7,000. So we can mark out the interest expense. Remember, we can skip right on through depreciation. That never affects cash, and we don't need to adjust for it in any way. Other operating expenses. I tell us in the notes that other operating expenses includes prepaids. So we're going to deal with the prepaid item with this one. So we had 15,000 of payment in other operating. So I have the 15,000 here as a minus because it's a payment. And then I came up to my prepaids. My prepaids went up by 2,000, so that means I spent extra money. So if I spent the money, then I need to show that I have another 2,000 being sent out, so another -2,000. So I spent 17,000. I've now taken care of all of those balance sheet items, and I'm almost done with this. My loss, I just don't need to put that on there. Just like with depreciation, I don't need to readjust for it. The only thing I have left is my income tax, 50,000. I don't have any income tax payable, so whatever it is, I paid it all off right now. So I'm going to put cash payment for income tax, 50 grand. That takes this away. Now I'm ready to add it up. And when you add all of these together, you should get that number that we had before, 108,000 as cash provided from operating activities. So that is how we go about, and that's the only difference from the direct to the indirect, you would still do the investing and the financing, but they're going to look just the same as the indirect method did. This is the only thing that's going to change, the only section. And you can see how it's just different. It's just looking at the income statement item by item instead of the balance sheet more item by item, the indirect method did. Okay, with that, we're going to close out this lecture portion, and then we're going to go into the Connect exercises.